welcome back here at the Forex Expo Dubai at our booth in Scope Markets. I'm Mohanad, Yakout, Senior Market Analyst, and this time around I'm having Joshua Mahony as my guest here, Chief Market Analyst at Scope Markets. How are you doing, Josh? All good?
Yeah, good. Loving Dubai. The traffic isn't great, but it's a good place to be, and exciting to be here at the Expo. There's a good feeling around the place.
Great. So this time around we'll be discussing everything about commodities, the oil story, what's happening with gold recently. Now I think today we're almost there, about $4,000 per ounce. What's driving this upward move? We'll be discussing a lot about gold and the recent move, and also a little bit about the gold to silver ratio. So kicking this off with oil story, we have recently had the OPEC meeting over the last weekend. Markets were expecting 500,000 barrels of increase in production starting November. However, somehow markets were shocked that it's only 137,000 barrels. It's strangely enough because the International Energy Agency was the one always saying that demand would be moderate. OPEC Plus was always optimistic. Is this a shift in OPEC's outlook for the upcoming period? Or will we see some softening in demand in the oil, or how do you see things going in the oil markets?
I mean, what I found interesting about this whole thing was that when we came into it, let's say a week prior to that announcement, in actual fact, there had been this idea that they're sort of tapering off in terms of the production increases. So I never really thought that we were going to go from 137K up to 500K. I've always presumed that it was going to gradually taper off. Then suddenly we started to see markets are expecting 500K, markets are expecting 500K, which caught me by surprise, quite frankly. And then that didn't happen. It actually came in line with sort of the downward trajectory we have been seeing. Much been made about this sort of move to grab market share within OPEC nations. Historically, they've been there to sort of prop up prices. Over the years, it's then come to the benefit of the US, because US producers essentially just pump as much as they want. OPEC nations are there trying to restrict production to keep prices high. And then more recently, we're seeing this sort of so-called drill baby drill over in the US, right, which everyone thought that was going to be great for US oil companies. In actual fact, that's because Donald Trump wants people to produce a lot of oil to bring down inflation, to allow him to see lower interest rates and alike. And ultimately, it's not necessarily great news when it comes to US producers. They're going to be the ones that are going to have to curtail production. And in actual fact, it's those in OPEC that are raising production. Question marks really about who's going to be able to raise production beyond this point. Many of the nations aren't actually able to make their quota, so it will be the likes of the Saudis really that are able to benefit from this. It does feel like as we come out of driving season over in the US, moving into the back end of the year, we're likely to see those production increases ease off, which is exactly what that latest number is telling us. So the supply and dynamic sort of, I think, should stabilize a bit from that perspective. And then we start looking at rig counts over in the US. Are we seeing a major pullback in terms of production from US? And then we start talking about demand dynamics and what's happening in terms of growth over the year ahead.
Okay, so in terms of trading, let's say someone now wants to trade oil. When it comes to fundamentals, do you think the number one thing that any trader should be concerned with, is it the economic activity and how it affects supply and demand in the oil market? Or is it more the geopolitical side of things when it comes to what's happening in the Middle East and how it could affect oil prices? So, I mean, everything, of course, affects the oil market, but what's the number one priority for you as of trading oil? What do you think?
It's very difficult, because I would say that some markets are a lot more clear-cut in terms of the driver than others. I would say that oil markets, it's almost like on a weekly basis that the narrative will shift according to what people are talking about. You know, last week there was this whole thing about the kick-starting of production out of northern Iraq, and that many US businesses are there, and therefore Donald Trump wants them to sort of get going. And so all of a sudden we're going to see a flood of new oil come into the market. Then you start talking about OPEC. So, you know, a week later we're talking about production of OPEC as a whole. Next week it could be, what's happening in terms of US producers? We're entering earnings season, so certainly when you hear from the likes of ExxonMobil and Chevron, you're going to gain a much better idea of what production levels are looking like from the sort of private industry over in the US. Then you have the whole story around growth, what's happening in terms of China. We have the October plenum this week, no, not this week, this month, where they're essentially sort of outlining their plan for growth for the years ahead. And people are going to be hoping for some sort of indication of what stimulus is going to look like from China. And so, personally, I find it a little bit more difficult to gauge exactly where that next volatility is going to come from, because of the fact that the narrative and the story keeps changing from one place to another. But what I would say is we are on a current downward trajectory. Trump wants that to continue, but I think there's likely to be limits to it. I think once you hit, say, $50 and the like, I think by and large you then see a very significant shift in terms of how many producers find it economically viable to produce, and that therefore sees a significant decline in terms of production, and therefore it's almost like a natural stabilizer. If prices go too low, people just don't produce, and then suddenly prices rise. If they go too high, then everyone produces and prices come down again. I think we're sort of getting towards the lower bounds of that dynamic.
Okay, on the longer time frame, let's say we're talking now in a couple of years for the oil market. Of course, we have seen the narrative during the past couple of years of renewable energy and the investment in this area and in the whole ecosystem. And recently, we have seen a report from the International Energy Agency that says, okay, by the year 2030, 5 million barrels per day of oil production will be displaced by the renewable energy. So that's something that was a little bit of a headwind for the whole oil market. However, at the same time, we saw the US thinking about cutting the fund of renewable energy by $13 billion. So we have a little bit of both. Some countries are supporting the renewable energy. However, on the other side, we're seeing this cutting of funding. So this is also something that could definitely affect the outlook on the longer term in the oil markets. Where do you see this investment? Do you believe that companies will still invest in the renewable energy and this will, on the long term, change the dynamics of the supply and demand in the oil market, or you don't see this as a threat?
Yeah, I think much has been made about this move out of oil. Certainly, sorry, excuse me, I've got a cough. Much has been made of this move out of oil. Certainly, that is likely to slow down with Donald Trump coming into power. The removal of the EV credits has sort of, in my mind, sort of contributed to the perception that it's going to be a much slower move away from oil. So for the time being, probably not necessarily going to be impacting it so much, but certainly I think later down the line, yes, perhaps that will be more of an influence. But for your everyday trader at the moment, it's quite difficult for them to position themselves in accordance with what's happening in the next year or two. I think it's going to be much further down the line.
Okay, now to the gold story. We're almost near the $4,000 per ounce levels today, and apparently we have many variables and many factors supporting this upward move on the gold gold markets. Mainly on the longer term, we have the de-dollarization narrative. We also have the bank purchases, central bank purchases, and we also have the risk-off story and the geopolitical tension. So gold today is almost approaching the $4,000 per ounce. The interesting thing is we can see that, there are factors to support this move, but the recent $100 per day move, is it supported by those factors, or do you think it's purely momentum trading? So where do you see gold trading, and how do you analyze the whole situation in the gold story?
I think gold is easier to predict than oil. Certainly, I think that the main driver in my mind is this move away from, say, US Treasuries in the perception as a haven, in part because of the incessant rise in terms of debt, and that's not going anywhere as a theme. Certainly the US versus, not the rest of the world, but this sort of growth of the BRICS nations means that there's always going to be significant demand that was previously going into US Treasuries that now appears to be going into gold. And so I think, not so long ago, it certainly didn't feel that long ago, maybe a year ago, people were talking about, could we hit 3,000 in gold? We do a lot of television appearances and it was constantly, are we going to hit 3,000? Are we going to hit 3,000? Soon enough, could we hit 3,000? Yeah, I mean, from my position, I think that the gold story is a lot easier to analyse than what's happening in terms of the oil market. A lot of the driver comes from this perception as a haven of gold versus US Treasuries. Of course, at the moment, we've got the US shutdown, which is another indication of just how unstable things are over in the US. But alongside that, you've got those BRICS nations that have been stockpiling gold. And historically, those countries have been stockpiling treasuries. We've now seen the holding of foreign gold assets now overtaking, on a central bank basis, overtaking the holdings of US treasuries. So certainly that has been a major dynamic that I don't think is going away. The incessant rise in terms of debt, that's not going away. Every time you see a political leader coming in and they start saying that they're going to raise taxes or cut spending, they get pushed out pretty quickly, right? So it's not popular to actually do anything about this debt issue. So I think that we can continue to rise. You know, a year ago, people were talking about, could you hit 3,000? Now it's 4,000. Could we hit 5,000? Generally, if you look from a historical perspective, gold does go on these very long-standing runs, and we're, I think, in the middle of that. I don't necessarily think this is suddenly going to come to a head. And with my bullish hat on, I would say, if we're doing this against the backdrop of markets at record highs, what happens when markets start to pull off and you possibly have this AI narrative in terms of big tech, possibly unwinding a little bit? Gold doesn't do well at that initial period of markets crashing. Certainly if you look at major collapses in terms of equity markets, gold also goes with it because you essentially see people liquidating all of their positions. But aside from that, gold does do well as a haven during periods of uncertainty if you're not seeing huge volatility, which is likely what would happen if we did see equity markets come off. So again, that could be another tailwind for gold.
Okay, regarding the gold and silver ratio there, it has been historically unusually high, the ratio between gold and silver prices. Although we have recently seen the silver prices as well move higher with gold, but the ratio still is unusually high. Do you think this means that gold is overpriced or silver is underpriced, or how do you see the relationship between both metals, gold and silver, taking into note that silver is more used in industrial uses than gold? So how do you interpret this?
I don't necessarily think that it's a case of gold being overvalued. I think that generally you'll see this relationship between the two, where often when the conditions are right, gold will outperform and then do really well. And then at some point you see people think, oh, this is getting so lofty that maybe I should sort of buy the cheaper version of it. So during good times, a lot of the time you see that additional volatility in terms of silver, and it plays catch up, and it's kind of what we've seen recently. We saw that gold-silver ratio so extended towards the upside that now we're seeing that sort of coming back in a pretty meaningful manner. People are really jumping into silver in a big way at the moment. I think that's likely to continue as long as gold rises. I think the two should move together, and generally the likes of silver should give you oversized gains as a result. But the flip side of that means that if you see a period of retracement, for example, in gold, you might see a more substantial period of weakness in terms of silver as a result. And if I was going to look in terms of where that might come from, like where would we see a chink in this story? Well, the back end of this year, we're expecting to see rate cuts. That's pretty much done from the Federal Reserve. Next year, that's where the question marks come into play. And if we see inflation rise and the Fed do, as their dot plot lays out, only cut one time next year, perhaps that starts to provide a chink in the armor and gold comes off a little bit, and that could maybe see a more oversized move towards the downside in terms of silver.
Well, that's interesting. Thank you so much for your insights. I'll probably have to wrap this up today. However, we'll definitely continue to have more insightful conversations with me and Josh here on the channel on Scope Markets. So thank you so much, and we'll see you later. Thank you.